Alrighty, folks, as one rental at a time is growing, we are able to attract other amazing individuals in the real estate game. And I have a surprise guest for you today, the one and only Jay Parsons. How you doing, Jay?
I'm doing well. Thanks for having me.
Absolutely, absolutely. So for the few folks out there that may not know what you do for a day job, let us know what you do and how you play in the housing game, and we'll get into a couple of key topics.
Well, sure. Well, thank you. So I'm the chief economist at RealPage, and what we do is get primarily a software company that gets data through our property management systems, and we're able to analyze that and kind of keep track of what's happening in the market. And so we have a team here that keeps track of things and tries to forecast where the market's going a little bit too.
Absolutely. Now, just for the audience that watches this, a lot of multifamily, a lot of single family. Would you say your orientation is towards multifamily? So we'll call it 5 units and above, and really probably 100 units and above.
Yeah, that's I try to cover all of it, but certainly we have better data on the larger multifamily side for sure.
Absolutely. So if we step back and look at the larger multifamily, I think we just got housing starts earlier in the week that kind of talks about single family 4 and below and 5 and above. And what did you really take away from this week? And then what's the bigger story on construction and inventory? Because we hear a lot of starts, a lot of things coming, but what's the real deal?
Yeah, no, it's there's been some good exchanges on Twitter or X about this, and the people on the ground just aren't seeing this, and we're not seeing it in the data either. There's really no acceleration of starts in our own data, and I've seen similar from some of our competitors and peers in the industry. We're seeing starts that are down 40+%. And you talk to developers out there, and they're all having trouble getting financing, and if they can, it's at very low loan to cost ratios, which means they have to raise more equity. And that's just hard to do. And so it's a very challenging environment right now for developers. And as a result, there's just not a lot happening this year, especially compared to the boom of 21, 22 for construction.
Yeah, I think there's really I don't think the average person understands how, I don't know, I'll call it tight lending is in kind of the commercial, regional banks who used to do the lion's share of this business. Even if they are doing loans, loan to cost is down, loan to value, for the residential folks.
Yes.
And that's going to impact next year, right? That's going to be supply that doesn't show up. And in multifamily, that gap, that air pocket that we're creating, that could actually work against the Fed, right? Because if it's not there, if supply is not there, that could be a problem, at least in the future, and maybe see shelter inflation come back. I think it's rolling over now, but if we create a big enough air pocket, it could be a problem next year or the year after, perhaps.
Yeah, I think more like 2025. I mean, the nature of these multifamily projects in particular, most of them that are getting built these days are 200+ unit properties that take, 18, 24 months to complete. And so we had a lot of starts at the end of last year. And so that really carries us through next year. But by the time we get 25, at this point, the industry consensus is that if the economy is still in pretty good shape, we should see some effective rent growth reemerge in 2025 as demand catches up to supply. So, I don't think it'll be a situation like we saw in 21, which is kind of a perfect storm of factors and broader inflation. But certainly, I think it's reasonable to expect some reacceleration in rents by that point.
Yeah. Well, so that's what's coming. Let's talk about where we are. I think to your point, you kind of made a comment earlier that there was a lot of construction or a boom, started in 2020, 2021. A lot of that product is landing now, and at least my opinion, you're in the weeds of this. A lot of it seemed to be pretty concentrated. So if you talk, national numbers, it may not appear like a problem, but when you look at the micro data, we got a couple of markets that got a lot of inventory coming, kind of all seemingly at the same time. Is that how you see the data?
Yeah, no, I think it's, the construction I think is pretty much in most spots across the country, but it's certainly there's certainly some areas that are getting a lot more than others. There's very few major markets that are totally immune to supply at this point. But there's a lot, and particularly these boom markets like Austin and Salt Lake City, Nashville, Charlotte, and then smaller markets like Huntsville is actually leading the nation, Huntsville, Alabama, and wow. In relative pace of construction adjusted for size. So sure. These type of high growth markets have a lot of supply, and the demand will be there in the long term. These are great spots, but in the short term, we're going to see a supply demand imbalance, which is going to create a very favorable environment for renters. But also too, even I see a lot of analysts that are just sort of, I think kind of lazily implying there's no supply in the West Coast as an example. And that's not really true either. You have some really high concentrated pockets on a submarket level of supply. And we see this especially in downtowns across the major cities on the West Coast, but also in, some particular suburbs, like, in West LA and some of the tech corridors in Seattle and in Santa Clara and in the Silicon Valley. So and even outside San Diego. So there are some hot spots, and even on the West Coast.
Yeah. The other thing I would love to talk about is, I call them financial engineers, and I'll define that in a minute, but there was a lot of activity in multifamily the last couple of years, a lot of, cap rate compression, a lot of novices, in my opinion, kind of jumping in, playing with spreadsheets, making numbers work, overpaying, raising LP money. Have you looked into that data? Did you see lots of assets retrade multiple times for seemingly lower and lower cap rates? Is a lot of this, because a lot of that I think is done, and we just got to pay the price for bad deals, frankly.
Yeah. There was I don't have the exact numbers, but there were a lot of new investment groups that came into the market these last few years. Not just for multifamily, but for SFR as well. I think what's interesting now is we're in this cycle where, a couple of decades ago, rental housing, SFR and multifamily really was kind of viewed as an alternative asset class, and even on the institutional level, we had limited interest in it, much more interested in office than in rental housing. And we've really seen that switch over these last 15 years since the great financial crisis, but especially since COVID hit, and a lot of office investors now moving into rental housing as well. So yeah, I think given the perfect storm of factors, more capital coming into the space, low interest rates drives up values. It made sense to retrade the asset if you could. I heard so many stories about these investors who said, you know what, I just got my 8-year return in year 3. Like, why don't I just go ahead and recycle some capital here?
Well, in my opinion, it was the classic kids game of musical chairs. If you were lucky enough, to get in and out. That's why I call them financial engineers. They were not operators. One of the things that I've seen about multifamily is you really do got to be a good operator. You got hundreds of families, sometimes several hundred families living together. It's hard, right? I own units. My biggest is 20 units, so it's nothing like this. And you're a counselor, right? You have to do all of that. So I can only imagine what 200 or 400 or 1,000 is. And I think a lot of people got in for easy money, and it's not easy.
Yeah. Well, and kind of to your point, I think when in a generational high period like that in 21 and 22, even the worst investors with the worst strategies and the worst asset managers, the worst operators, all of them could kind of benefit from this rising tide boosts all ships effect, right? But now I think we're in a period of the cycle that really separates good investment strategies and bad investment strategies, good operators and bad operators. And I think you're going to see a lot more of that kind of in the next couple of years.
Absolutely. Well, one of the things I want to talk to yourself as a chief economist is kind of shelter inflation. It's come off the boil a little, but still high. I think the last reading CPI was like 7%, 7.1, something like that. Are we on a trajectory where the math says it will come down over the next several months, just given the way it's calculated, or do I misunderstand it and it may spike again?
No, you got it. And if anybody's kind of read some of my posts on this, I try to comment on it every month when it comes out, and it's something that I get pretty fired up about. So I could get kind of down the data nerd rabbit hole pretty quickly here, but with that warning. So what's interesting is, you probably know about shelter is the one thing that's not really real-time pricing in the consumer price index. So people listening, I mean, you think about what's in the CPI, you think about things like food and gas, those kind of things. Like, everybody sees kind of a real-time price when you go to the store, and that's what's reflected in the CPI. Well, shelter is very different. Shelter is predominantly just rent, even to represent homeowners, and it's designed what the industry would call, like anybody who's an operator would call, more like your in-place rent or your rent roll, which is going to lag your asking rents or your street rents. And so because of that, it's kind of a slow moving ship. But I think anybody in the business knows that, if your asking rents are quickly going down, your rent roll revenue and your in-place rents are not going up, right?
Right.
And so it's a preordained, kind of predestined downward path that I think will, continue at least over the next 9 months. Like it's
Right.
a slow moving ship. It's not going to reaccelerate. Like I think we have, and I think the Fed's sort of holding out for the 1% chance that it does, and they kind of have
Right.
to, because they've kind of, they've relied on this metric, so they can't change their story now. But we all know where this train's going.
Yeah, I've tried to, a lot of people that watch my channel aren't economists, aren't in the weeds like yourself, or trained as an economist as I was. I try to explain it as a roller coaster, 12 carts or whatever they're called, and we've got 3 of them over the edge, and there's 9 more coming. It's a mathematical certainty, right? It's
I
not,
like that. Yeah.
it's not an opinion. So does that play?
Yeah, no, it does. It's kind of your point, like the carts, like the way that, and I'll try to say this in a way that's it's your analogy is much simpler than mine, but if you have 12 carts, like each one's a month, right,
Right.
out of the 12-month calendar. And what's happening is, like, everyone acts surprised when everyone looks at year-over-year numbers.
Yeah.
Well, the year-over-year number, 11% of it is already determined, right?
Correct.
It's just the next month. So what's happening right now is we're replacing big numbers from last year, like let's say September 2022, with a lower number for September 2023. So when we look back, like the biggest bumps in shelter inflation occurred from in the second half of last year through February of this year. And so those are numbers that we just are not realistically going to surpass. And so again, I think by the time we get to the spring, maybe it changes a little bit, but I think by spring next year, those numbers are going to look more normal.
Yeah, I've been harping on this every month, because I think the next 2 months are actually the biggest in this biggest and third biggest in the series. So there should be meaningful drop. Now, obviously, gasoline or something else can come behind it and kind of
Yeah.
it. But shelter, unlike everything else, is this formula, right? We're just going to take the last month or last year's number off and put it on this one. This one's going to be smaller than that one, and that means the average goes down. It is just math for shelter.
Yep, it's easy math. It's not complicated.
No, well, it's easy for economists, and it's really hard for the public, because they just blows their mind. It's like, how can that be? It's a whole thing.
Yeah, well, and the other thing too, I was pointing out too, is like I see a lot of people on Twitter comment was like, hey, well, this can't be true because my rent is still going up. And I always remind people, it's like, hey, like the numbers you see are averages and medians, and so there's always going to be people who are on both sides of that average and median. There's 48 million renters in our country, something like 49 million renter households. So you are not, any individual is not necessarily representative of the overall population.
Yeah, average and median, really, again, another thing that I have to explain sometimes. It really blows people's minds away. I do want to, I know you do a lot of work in multifamily. I get asked this question. I'll give you my answer and then correct me if I'm wrong. I think there's a lot of people that talk about rent, and generally speaking, they're referring to multifamily, right? It's the biggest number. It's out there. A lot of units are coming construction, like we talked about. At least the numbers I've seen is rents in apartments are, I actually you posted this and I reached out to you. I think the last month was up 0.1 again, nationally. Coming, last year was 9% or whatever it was. So again, back to that whole rent coming down thing. But when I look at single family, and I haven't found a good report for single family, so I only can use my 20 years of experience, single family rentals seem to be up. Everybody wants to be in a home. They want the backyard. They want space for Zoom calls and all of that. Have you seen data breaking down multifamily versus single family? And if you haven't, where would one person go to see it?
Yeah, no, there are. I mean, to your point, there are a lot of data sources out there, but they don't agree with each other, and so it's really difficult to figure out what's what. Like I saw one on the low end that had single family rents close to zero, like apartments. I don't think I really believe that one, but I think the most that I think the general view is, whether the numbers 3% or 5%, we're not in double digits anymore. The numbers are moderating, but I think it's pretty clear that single family rentals are outperforming multifamily at this point. But you're still just seeing some normalization. You're not going to sustain 10% rent growth.
No, and nor would I want to. I think it's very unhealthy. It becomes very, problems start breaking when you see double digits like that. So, but I was just curious, single family, multifamily. I actually think, because again, I've played in single family and multifamily for 20 some years. I actually think they run in different cycles. Everybody talks about the real estate market. In my 20 years, single families can rip, multifamilies can be soft, and then single families could crash. And I really see different cycles, but everybody wants to put them together. This is from a buying and investing landscape. Do you see it as one big, kind of, real estate market, or do you kind of break it apart?
Yeah, that's a good question. I think of it in kind of concentric circles where there's a lot of overlap, but there's also some unique aspects. One thing I think is really important is sometimes, the economists, like myself, sometimes we make this too much of a cold process. We imagine people sitting at a kitchen table and saying, "Hey, is it better and cheaper to rent or buy? And do I do single family or multifamily?" Like most people, there's always somebody who does, but most people that I've ever met in real life don't actually think like that. Like you think about like what are the drivers and to go into single family rentals. Oftentimes, like this is a life stage and a lifestyle thing. I'll give you like some real stats here. Like the median age for an apartment renter is 31. The median age for single family renters are early 40s and more likely to have kids. We see very few, particularly school age children living in market rate apartments. Now, it's a little different in affordable housing, but in market rate, we just don't see it as much. And so I guess to answer your question is I think that both kind of obviously are tied to the broader economy and household formation. I mean, all the usuals demand stuff, but there are some nuances that are driven by demographics. And especially if you're in an area that's an aging population and not seeing a lot of like in-migration of young adults coming out of college, things like that, single family rentals are probably going to be doing much better in those situations. Or on the flip side of that, it's a very, younger market that's booming, not enough apartment supply for that demographic. You can see apartments do better. So again, there's some overlap, but I think also some unique, obviously, differences there.
I love that. I love that. Well, I'd be remiss if I didn't get a chance to ask you about, what your crystal ball shows, and obviously yours is as broken as everyone else's. But I see a lot of a comparison, or a lot of people want to make our next 2 years in the real estate game like the GFC. Everybody wants to talk crash. Everyone wants to talk this. We got existing home sales today. We can talk about that in a minute. I actually think, and I don't know if you've done research on this, I think the next couple of years is going to be very much like the S&L crisis, kind of the early 80s. And, we could have some significant commercial pain, office, other stuff. I don't know if we're going to have another RTC or whatnot, but there's some pain coming. It's not, in my opinion, the GFC, probably more akin to the savings and loan crisis, but I'm curious if you had a look at any of that.
Yeah, no, it's a tough question. Like you said, I like to tell people always ask about the crystal ball, and I always tell them it's fuzzy, not broken entirely, just very, very fuzzy.
Fair enough, fair enough.
But no, it's obviously as much art as science. But no, I think that's a good question. I mean, I think there's a lot of the doomers on Twitter who they've predicted, what's the joke, 500 of the last 2 recessions. So
yeah, exactly.
I think I think let me put it this way. I think 24 is gonna be a tough year, and I think this is you've had a lot of groups out there, particularly in the multifamily side, newer groups that are going to have financing issues. The slowdown in rents really isn't that. I mean, I don't want to say it's not a problem, but it's like the compressing margins is manageable for somebody who's been a long-term holder, has a manageable cost of debt, doesn't have their maturing loan. Expenses could probably go faster than revenues for a year or two, and most owners can withstand that. Right. But if you're in this group where it's a financing issue, it's not a physical real estate issue or a fundamentals issue, it's a financing issue. Right. I think 24 could be very, very challenging for that group. And so I don't know that I agree with you. I don't think the GFC is necessarily a good comparison point to that. There's some similarities, but that point too, we had a massive recession and there was a fundamentals issue in addition to financing issues. And actually the financing issues wasn't even in multifamily. It was really single family. Yeah. So I think this one is a different situation. And those who at peak prices with short-term floating rate debt, I mean, some of them are going to be in a world of hurt.
Well, I think that's the key. And I actually talked about this with Ken McElroy, obviously a big multifamily investor. And I was telling him that I saw the same financing stupidity the last couple of years in multifamily that I saw in residential in 2005. The problem in residential in 2005, you didn't see the pain until the debt reset, right? 51% of debt was, or 51% of mortgages in 2005 were ARMs. Some of that, I think 14% of that was picket payment ARMs. Toxic garbage. We had the same kind of behavior in multifamily, in my opinion, with all these new entrants, bridge debt, 2-year IO, all of these 5% rent assumptions or rent growth for 5 years, all of these just Excel-based stupidity, non-operators, financial engineers. There's a price to pay for that. But residential, at least heading into 2023, I think 97.5% was fixed. You know, Black Knight puts all these numbers out about how much is below 5, below 4, below 3. The pain coming, at least nationally speaking, is not residential. It's multifamily, I think.
Yeah. Well, I'd agree, but I also say that I think some of that gets even. Let me say this. I agree with you, but I also think that even on the multifamily side, it tends to be overstated, because when you look at all the debt in the U.S. for multifamily, there's $2 trillion multifamily debt. There's about 4% of that that's in what you'd call the risky categories, the things you just mentioned, these new debt funds, CLOs, and of course CMBS. Like, those are the more risky, debt types. I'll also give you a different data point. Like, on the bank lending side, about a third of multifamily debts held by banks, they're still reporting very low delinquency rates. In fact, delinquency rates in multifamily loans are even less than single family home mortgages. And that's not to say that they'll do better, but I'm talking about the bank balance sheets. Multifamily is not the albatross like office loans are. So I think what's going to happen though, and I'm trying to add a little bit of nuance here, but I do agree with your point. I think there's going to be a very loud but small share of the market that's going to be pretty ugly.
I agree with all that. Well, you did say, I know we've only got a couple minutes, you have a hard stop. You did say there's some similarities between now and the GFC. I'd be remiss if I didn't ask you what you see.
Well, no, I meant like in terms of what you mentioned, like obviously like the single family ARM versus the, like for those who are not familiar with what's going on in multifamily, like there's these groups that spun up, and basically the strategy is, you get 2 or 3 year floating rate debt. You have a big value add program, capital intensive, spend millions of dollars, jack the rents up 20-25%. Well, that works when rates are low and rents are shooting up, but it doesn't work when all of a sudden you can't push the rents that much because renters have a lot more options. All of a sudden there's higher vacancy. And on top of that, now you're refinancing a much higher cost of debt. So that's what I'm talking about with like the similarity of like those who kind of like the ARM, like that's the part where there's a commonality there.
It's a lot of what's coming, I think, to your earlier point, is financing pain.
Yeah.
Right. It's a bad debt structure or capital stack or whatever you want to call that, but it's pain nonetheless. Yeah.
And it could be, I think too, I think a lot of the headlines miss this. It's like, it's not a physical real estate issue for the most part. You can have a great asset, but in a lot of cases, it's the next owner who's going to do really well on that asset.
Yeah, I mean, I know about some Class A properties that was bought at a 3.5 cap. If you bought that at 3.5 cap IO debt that has to refi in 2 years, you're in trouble no matter what. I mean, given the cap rates are 5.5 now, I mean, that's just a huge move. And there's some pain coming. I know you got go ahead. Closing thoughts, and where can people find you?
Oh, sure. Well, let me just add too, is like, I think that I think you're going to see some separation between the groups that are well capitalized and able to fill that gap through capital calls and extra capital, things like that. There's going to, some groups can absorb that more than others. And so I think what we're going to see is some winnowing out of investment groups in this cycle. But yeah, no, you can find me on Twitter and LinkedIn. Just search my name. You can also go to realpage.com/analytics. We have a blog that has a lot of content on there, mostly about multifamily.
Folks, do yourself a favor, follow Jay Parsons. That's with an S, Parsons with an S. Thank you, buddy, for being here. I appreciate you. Have a wonderful week.